and I am Jason from Fix My Books. Today we're doing another segment on leaving Canada. I'm not doing this because I particularly want to do it or I'm telling people to leave Canada. It's very, very common. So there's a lot of Canadians which are born in Canada as well as immigrant Canadians that are now becoming immigrants. So they are leaving Canada. And this is just a question that we get so much of through our website. So what we wanted to do was just make a video on potentially things that you need to think of if you're thinking of leaving Canada or if you've already left and you think you may have some sort of tax obligation and or filing obligations. So here are some basic things that you need to know about departure tax, so exit tax. So what is departure tax? And I promise you all the slides are not going to look like this. A lot of them I've put pictures so it's not so wordy and boring. So aka exit tax, it's a term used to describe the deemed disposition rules when ceasing to be a tax resident in Canada. So subsection 128.14. This tax residency and residency to do with permanent residency and immigration are two different laws. So tax residency is obviously very different from immigrant residency or immigration. So just be aware of that, because you could be a tax resident somewhere, but not actually be a permanent resident or even a legitimate resident with a right to work there as an immigrant or a citizen. So they're two different things. So just be aware of that. I've done some videos previously on the channel that, I can link below that explains a bit about tax residency, but just be aware the two things are different. They are not the same thing. They fall under two completely subsects of law. So you can see the law that I'm referring to here. So when you cease to be a tax resident in Canada, what actually happens is you're deemed to have disposed of property equal to its fair market value, which can trigger capital gains or losses. But what does all this mean? This is very legalese. A lot of people don't understand this. So effectively what it's saying is when you're no longer going to be a tax resident in Canada, basically the stuff that you bought when you entered, even stuff that you had when you entered, if that is the case, or stuff that you bought while you were in Canada, if it is appreciated in value or if it has lost value at the time that you leave, which is the fair market value, this can trigger a capital gain or loss as if you sold it, as if you sold it. So what would then happen is you need to report this gain or loss on your final Canadian tax return for your year of departure. So I've got a diagram which kind of explains this, makes it a little more easy to understand. I'm trying to be fun. This is me being funny. So you arrive in Canada, or say you're born here, Canadian citizen or new Canadian tax resident. And let's say you buy some stocks in your personal brokerage account. This is not an RSP, TFSA, nothing like that. No registered account, just you bought some stocks in a Questrade account or whatever. You hold them during your time here in Canada, and they've gone up several years, over several years. They've gone up in value, and that's awesome because now you obviously have more worth, right, in yourself. But then you get this job offer overseas. So say you get this job offer in Europe or something like that, or America or India or Australia or wherever, it doesn't matter. But you decide to leave. And what actually happens in that circumstance is the gain that was made, even though you haven't sold the stock yet, it's as if you sold the stock on the date that you leave. So if you bought this stock at $1 and now it's $100 during your time in Canada, you haven't sold anything. But that $99 gain, the difference between the adjusted cost base and the sale price of when you left, the fair market value, is the gain that you made, and so that becomes a reportable transaction and it becomes taxable. And I specifically use stocks because this is something that, it actually applies to most people. So it really depends on whether or not the asset is subject to tax or whether it is not subject to it. So which assets are subject to this deemed disposition, departure tax, exit tax thing? Well, generally speaking, the law says that all property owned by the individual at the time of their departure is taxable. But then what happens is, if you look at the law 128.1, you see there are some exceptions listed there. So it's kind of like it's everything but this stuff. And so it can be complicated for people to understand this because reading the law is not easy. I advise you to actually speak to someone if you don't understand it. So this usually means paying for legal or tax advice. Don't just assume that you know it because you read on a blog post somewhere that, oh, this is kind of similar to my situation, whatever, because it does actually get tricky and there are certain nuances to it that you may be captured by and your situation may be captured by, and then it just creates a headache for you. So what assets are subject to it? So this is just a lot easier for people to understand. So do I have this stuff, right? So it's really stocks, shares. I mean, these can be shares or stocks that you own of even Canadian companies, like, a corporation that you set up in Canada. So stocks, shares, and investments, generally speaking, foreign real estate. So obviously real property that's situated overseas, so it's not in situ in Canada. Collectibles and jewelry, and so this is called like personal use and listed property with a value greater than $10,000. This is a little one that some people, don't realize that they have or that's subject to it. So if, for example, you entered the country, let's call it 2018, when the price of gold was very low, and you owned a whole bunch of gold jewelry at the time, and it was worth, only $5,000. Well, now in that time, it's gone up several 100%. So is it still worth $5,000? Well, the fair market value, if you left Canada today, may be substantially more, and therefore the gain on this property would be subject to tax. So there's other stuff as well, which doesn't really apply to people, but I'm just listing it anyway. So it can be like intellectual property rights, like trademarks and that kind of thing outside Canada. And then obviously, if you own an interest or shares in foreign corporations, partnerships, joint ventures, foreign trusts, that kind of thing. So that's a little more up the other end of the scale. Like if you're doing international business and if you've got foreign trust situation, that's a different end of the scale. But for most people that are watching this, it's probably going to be stock, shares, investments, foreign real estate is a pretty typical one amongst the snowbirds, as well as collectibles and jewelry, that kind of thing. But just note that this is not an exhaustive list. This is just the most general items and the most common things that we see. So which assets are excluded? Well, Canadian real property. So this is real and movable property in Canada. So it's usually just real estate. Canadian resource and timber resource property. So this is like licenses for resources. Property used in a business carried on in Canada. So it has a Canadian permanent establishment. And I'm not going to get into the nuances of that because that's a whole different thing. But if you want to see a video on that and that be explained, happy to do that for you as well. And so this is one that really falls in with a lot of people. Registered retirement plans, so your RSPs, your TFSAs, that kind of thing. And then lastly, another common one that we see is certain trusts, which, they're resident in Canada. So you can see all the Canadian flags. This makes it very simple. It's usually stuff that's Canadian based as well. So do you need to pay it? Well, yeah, you probably do, unless you meet some sort of an exception, or you actually elect to defer it, which is another complicated matter that some people opt to do. So you'll likely need to file a T1161 in this circumstance, and or other forms. And I've put these other forms at the end so you kind of know, oh, I've heard of that form, or, oh, let's have a look at that, see if it applies to me. And obviously you don't need to pay it if you don't own anything, or if none of the property that you own is reportable. And when I keep saying property, I don't mean property as in a house. I mean property as in stuff. Like if you don't have any rights to anything or options to anything, domestic, overseas, and if you don't own anything, well, then you're not really going to be paying any tax. So the exception, this is called the short-term residence rule. And a lot of people are looking at this rule online. And the reason why we're talking about it is because some people think when they look at it, oh, that meets my criteria, therefore I don't need to pay tax. So what we're seeing with this is people are reading this in this specific way. So generally speaking, if you lived in Canada less than 60 months within the last 120 months, you're considered a short-term resident. So if you kind of came into Canada, left within 5 years, you're considered a short-term resident. And that means that some of the assets and property you owned when you became a resident of Canada may not be subject to departure tax, but they're reading it as if everything that they have is not subject to departure tax, because obviously they want to look at it favorably and not pay any of the tax. However, that's actually not the case. It's dependent on what type of property that is purchased and what is owned. And whilst it may be the case that if the property you received came with you when you immigrated to Canada, or if it was in some circumstances part of an estate that you inherited, then you don't need to pay any tax at all. But it's really only specific to that certain situation of property that came with you to Canada. However, the deemed disposition still does apply. So the property and other items acquired after you became a tax resident of Canada. So say, for example, January 1, 2020, you became, or 2021, you became a tax resident of Canada, but you left on January 1, 2024, and you brought a whole bunch of stuff with you. Yeah, that's fine. You may not be in a situation where you're paying departure tax. Always double check this. Don't just, I'm not talking about your specific situation, so you need to have someone look at your situation. But say they did start a company in Canada at that time, and that company appreciated in value, well, that stock that is now worth more money, and therefore it's likely going to be taxed. So when it comes to this, don't just read this rule online, 128.14b4, and then just go, oh, I'm short-term resident, disregard. No, have someone look at your situation, because this is where I think a lot of people are being tripped up, especially the new immigrants, where they're not reading this in the unfavorable way which they should be reading it. So there's also elections, like I spoke about before, and this is where you can defer your departure tax if you can't really pay it at the moment. So say you may be asset rich, but cash poor, and some of these assets may be invoking the departure tax. You may elect under subsection 2224.5 to defer this departure tax. So it's going to allow you to defer the payment of the tax on certain property items when you file this form, the T1244. So CRA will need to approve this, because generally the security is going to have to meet several requirements. So it needs to be liquid, as in it's easily convertible to cash, or it's an equivalent to cash, it's realizable, and it's payable on demand. So that means the CRA can just say, oh, we need it now, and that it converts to cash easily and it covers the debt. It's unconditional, and there's no claims from third parties. So you can't put conditions on it where, if certain things happen, it's not going to be paid. No, it needs to be unconditional. So they need to be able to take charge of it very easily, and there's no one else that's going to come in and say, hey, actually, no, I was owed this because blah, blah, blah agreement. And it obviously needs to have adequate value to cover the deferred tax liability. So this will be determined by the CRA as well. It needs to have a relative value which is higher than or equal to the tax that you're going to be potentially deferring. So I put this here. So what are some acceptable forms of security? So bank letters of guarantee from Canadian Schedule 1 or Schedule 2 banks, and you can look that up online. There's just a list of that stuff because that's quite common. Standby letters of credit from Canadian financial institutions. So that's not line of credit, that's letter of credit. That's a different thing. First ranking mortgages on a Canadian real property. So for example, if you own a home and the CRA can have a mortgage which is like at the front on the property, and basically they can take charge of the property if you were to default on the debt, that kind of thing, and there's no one else that can claim it ahead of them. So you can also pledge your stocks that went up in value. So say you had all these stocks that went up in value, you can't actually, you don't want to sell them, but you don't want to pay the departure tax, you can actually pledge these stocks as security. Another one is cash deposits. I don't know why they put this. I mean, they do this at banks as well. You can put a deposit of cash against a loan, but why not just use the cash? So you can do cash deposits, whereas you may want to just pay the amount outstanding, and other liquid assets. You can't use a line of credit. All right, so we get asked this quite a bit. No, you cannot use a line of credit. A letter of credit is fine. A line of credit is different. A line of credit is like, just on your account where this can be cancelled at any time at the bank because, you own it. So you can just call up the bank and say, oh, I want to cancel that line of credit. So the CRA can't take charge of that, and therefore they don't accept that. And just lastly, I'll touch on some forms that are going to apply to you. So when you leave Canada, you're obviously going to have to file your final T1, which is due April 30 or June 15, depending on if you're a sole proprietor, partnership, that kind of thing. And this is your tax return, your normal tax return, and it's done in the final year that you are a Canadian resident, and you report your income as normal, but also the departure tax you owe. If you owe any departure tax, that needs to be paid by April 30. Even if your filing date is June 15, you will need to pay these taxes by April 30. I mentioned before the T1161, so this is where you list the reportable properties with a fair market value greater than $25,000 in aggregate, to then go into the T1243 to report any gains or losses if the property is subject to the departure tax. So you're not actually buying or selling anything. It's like a theoretical sale, right? The deemed disposition. You've also got the T1244, which is what I spoke about before, which is where you're applying for this deferral of departure tax. And then there's another form as well, but I'm not going to get into this one. This is really about, tax planning, and especially, depending on what country you're moving to, there may be situations where this may be optimal for you. And it's where you elect to report a deemed disposition of certain properties if you're including or excluding the certain property. I'll just give a brief example of one. So one may be if you want to crystallize the principal residence gains in a property when you leave, and you expect later that you're going to be selling that property, but you can't actually sell it right now for some specific reason. So you may want to crystallize all the gains, shove it under principal residence exemption, have that gone for tax, and then sell the property. And that way there's less of an issue later, as well as some other countries you may be moving to may be able to use that as the basis. So if you do sell it briefly while you're a tax resident in the other country, you may not be paying exorbitant capital gains taxes, that kind of thing. So that's that. I hope that's helpful for you. If you have any questions, or if you feel like this is super confusing, or also if there's anything in here that you'd like me to delve into in more detail, just put it in the comments below. Don't forget to like and subscribe. And thanks again for watching the video. And yeah, if you want any other videos on this sort of topic, let me know. Thank you.